When policy uncertainty is high, which it has been for months, then investors get cold feet, and this could push them away from dollar-denominated assets. It's likely no coincidence that the divergence between rate differentials in the US dollar/euro pairing began in April, just when Trump announced the Liberation Day tariffs, blindsiding investors and trade negotiators around the world. So chronic economic uncertainty likely plays into it, but those tariffs do too. The wave of new levies on imports since January has brought the average US tariff rate from 2.5% to nearly 20%. In theory, tariffs should strengthen the dollar because they incentivize domestic companies to buy more American goods. But in reality, the opposite is happening. That's because lots of other countries have retaliated with their own hefty tariffs on the US, reducing foreign demand for American goods and US dollars. And all of this has weighed on US economic growth. In January of this year, the IMF projected that the US economy would grow by 2.7% in 2025. In July, they revised that down to 1.9%. By comparison, the European economy's growth projection remained stable at 1%. So even though the US economy is still growing faster than the European economy, it's the slowing momentum that could be raising concern. Here's another way of looking at it. US real GDP growth has been below average since Q3 2024 and is projected to remain well below that average until the end of 2027. That matters because the market is forward-looking. It sees that the ability of the US to grow its way out of its debt problem is diminishing, especially as its growth forecasts are revised down while Europe's remain stable. So all of this has important implications for the US and global economies and the US stock market going forward. For one thing, it signals that the world's confidence in the US bond market and the US dollar as safe havens is wavering. The risk-free asset is no longer seen as truly risk-free. It's long been said that the US dollar appreciates when the US economy is weak and when it's strong. This is called the dollar smile theory. When it's weak, investors tend to flee to safety, and that has long been US treasuries and US dollars. And when it's strong, optimism often drives rallies in US equities. But this is a crisis of confidence in the US itself. For the first time, a major global risk is causing capital to flee from the dollar, not to it. The traditional playbook is being rewritten.